The world of investment banking and private equity have a lot more in common than what you might think. And the best example of this is if you walk into any private equity firm, you're going to see that almost 60 to 70% of the staff there are in fact ex-investment bankers. So in this video, I'm going to talk about the reasons why so many investment bankers transition into private equity, as well as some of the commonalities and differences which exist between the world of private equity and investment banking. So one of the major reasons why so many investment bankers go into private equity is because of the work itself. Now, as a general rule of thumb, the work is always a lot more interesting on the buy side than it is on the sell side. Now, for those of you that are new to the world of sell side and buy side, let me just give you a quick introduction. Whenever you hear the word sell side, think investment banking. And whenever you hear the word buy side, think hedge fund, private equity firms, pension funds. They're the ones which are buying securities, shares, derivatives, companies from the buy side, i.e. investment banking. It's investment banks which represent and which sells securities and businesses to the buy side. So again, sell side, think investment banking. Buy side, think private equity, hedge fund, asset management. So they're the ones which are buying. Now, the implication of this is pretty important because when you are working on the sell side, when you are in investment banking, you're pretty much representing your client. So when you are building your financial model, you're not really building the financial model from the perspective that you want. You have to use your client's assumptions. You have to use their numbers. You have to represent them the best way possible. And if you have some unreasonable clients where they think their business is worth 1 billion, but in actual fact, it's only worth half of that, you have to try to represent that the best way possible. But the truth is, you don't have the total freedom to build the kind of financial models that you want. Whereas if you go into the buy side, if you go into private equity, that's where you're going to have the freedom to build the financial models that you want, because no one is going to tell you what assumptions you should use. No one's going to tell you what numbers you should use. On the sell side, your clients are going to have a very big input as to how they're represented, as to how you build that financial model. But on the buy side in private equity, you have a lot more freedom to express the kind of financial models which you want to build. So this is why the work is definitely a lot more interesting on the buy side than it is on the sell side. So another reason why so many investment bankers go into private equity is because of, I guess, detail. Now this relates pretty much to point one, which is the work itself. But on the sell side, there's one thing which I have realized from personal experience. Now, although when you are building your financial models, when you are building marketing materials, you have to be accurate, you have to get things right. But something which is far more important on the sell side is timing and speed. You see, when you are working in investment banking, it's all about finishing and completing as many deals as possible. And it's all about pretty much just cranking out the deals one after the other. And the worst thing that can happen in investment banking is if you lose a deal. Now, on the flip side, the worst thing that can happen on the buy side is if you invest in the wrong deal. So on the buy side, you have to be accurate. But whereas on the sell side, you have to be accurate, that's important, but what's more important is finishing the deals on time. And again, it's all about maximizing your time, finishing as many deals as possible. It's all about completing as many deals as possible so you can collect more commission. But on the buy side, you don't have that time constraint. It's all about quality. It's all about investing in the right company because you have a limited amount of cash for you to invest in. It's more important that you get the investment right than for you to invest in many companies. Now, because of this, when you are building your financial models in private equity, you have to be a lot more detailed. It's not just good enough to model out a business like you would in investment banking. In investment banking, on the sell side, you can pretty much project out revenue by using the average growth rate for the last 3 years and just project that out going forward. And that's fine for investment banking. But on the buy side, you have to be a lot more detailed than that. You can't just take the average growth rate. Here, you have to examine the revenue line. You have to examine the drivers which drive revenue. You have to examine the drivers which drive cost. You have to examine how much does this company need to spend in order to generate $1 worth of revenue. And you have to examine how can you increase that? How can you reduce costs? So there's a lot more analysis which is taking place on the buy side. And this analysis, it takes time. And because of this, it's a lot more interesting in order to build these kind of financial models. So the third reason why so many investment bankers go into private equity is having an eye for investments. You see, when you are in investment banking, when you are on the sell side, you're pretty much a clog in the machine. You're all about just cranking out as many deals as possible, collecting your commission and moving on to the next deal. Now, there are some benefits to this because whilst you are doing that, you are building your skills in Excel, in financial modeling. You're learning how to break down financial statements. You're learning how to dissect marketing materials, how to build marketing materials, how to interpret specific numbers, and you are becoming really well versed in accounting and corporate finance. Whereas on the buy side in private equity, you need those specific corporate finance skills, but you're looking at things from a different perspective. You're looking at things from the perspective of an investor. You're no longer just cranking out deals. You're using those specific skills which you've learned in investment banking, so financial modeling, accounting, breaking down marketing materials, and you're looking at things from the perspective of an investor. Can you invest in this company's IT infrastructure in order to streamline production and improve operations? Can you increase the marketing spend in this business, which will translate into additional revenue? So you have that specific eye for an investor. That's what you need when you go into private equity on the buy side. But on the sell side, you don't need that. Now, some candidates, they already have that and they want to exercise that part of their brain. They want to exercise that investor's point of view. Now, for those of you that are interested in learning how to build financial models on Excel, whether it's building DCF models, company comparable models, M&A models, LBO models, then check out our Excel financial modeling course where we show you how to build all of this step by step, as well as going through case studies. Now, for those of you that are interested in going into private equity or investment banking, then check out our interview and recruitment guide where we break down each of these industries in step by step, where we show you how to structure deals, where we show you how to ace your interviews by going over hundreds of questions and answers. And we've had thousands of candidates come through this program and they have all reported a lot of success. So definitely check those out and I'll leave a link in the description below. Another reason why so many investment bankers go into the buy side or go into private equity is because of the salary and culture. Now, needless to say, the salary on the buy side is a lot higher than it is on the sell side for obvious reasons. Like I've already mentioned, on the sell side, when you are in investment banking, it's all about working on as many deals as possible. It's all about finishing one deal and moving on to the next one. And you're just collecting commission on that. The problem with that is you don't have any skin in the game. You're not invested in any one particular deal, like in private equity, where you are invested in specific deals, so the return is much higher. So again, the salary and the bonuses will be obviously much higher on the buy side. Another benefit is when you are working in private equity, you get to invest your bonus and a part of your salary in the fund. So you can benefit further with the fund's performance. So you can invest your salary and your bonuses in the fund and benefit from the fund's performance. But you can't do that on the sell side. Sure, you can invest in the bank stock, but it's not the same. So another reason is the culture. Now, the culture between investment banking and private equity, like I've already mentioned, is pretty similar. And what's also interesting about this is the fact that given that investment banking is considered as a stepping stone into private equity, in investment banking, you are going to develop all the skills that you are going to need in order to work in private equity, from building financial models, dissecting financial statements, breaking down marketing materials. You are going to develop those skills in investment banking and you are going to be using that in private equity. The only difference is you're going to be analyzing everything from a different perspective, but the technical skills is still the same. And because of that, investment banking is considered as a stepping stone into private equity. So some junior bankers, they pretty much join investment banking for the sole intention of eventually leaving and going to private equity. So you do have that culture which exists in investment banking and private equity. Now, in terms of culture, there's also something else which might surprise some of you. And this is a reason why people tend to break into private equity, but they realize this later on down the line. Now, I'm sure everyone knows that investment bankers work long hours, extremely long hours. But the reality is, a lot of investment bankers, they do get used to this. They do get used to working long hours. But the one thing that we can't get used to is having zero control over our schedule. What I mean by that is, you pretty much can't schedule any social events, right? You can't schedule to go to any weddings, to any meetings, parents' evening, even weddings and funerals. Pretty much whenever your client needs you, whenever you need it in the office, in investment banking, you have to be there. This is especially true when you're a junior investment banker, so as an analyst. But when you do transition onto the buy side, you do have a lot more control, and that's a huge appeal. But you only realize how important having control of your schedule is when you start working in investment banking after 6 months, after 5 months of not being able to see your friends regularly, of cancelling on them. You're going to start to miss that control over your schedule. And having that control of your schedule is a huge motivator for why junior bankers do want to either leave investment banking or transition into the buy side. Okay, so I hope you've enjoyed this video and you have a better understanding as to why so many investment bankers transition into private equity. And again, if you are interested in learning about investment banking or private equity, then check out our interview and recruitment guide, where we pretty much break down the whole industry from A to Z, from lifestyle to recruiting, how to recruit better, and how to pretty much ace your interviews. If you are interested in learning how to build financial models, we have an amazing course on this where we teach you how to build Excel financial models step by step in an easy and friendly manner. Again, this is designed for non-bankers to get you up to speed to the point where you can successfully build financial models from A to Z. So I hope you enjoyed this video, and I will see you in our next one.